Welcome to the deep dive.
Great to be here.
Today, we're really plunging into quite a story, LKQ Corporation. It feels like a company fighting to rewrite its own narrative,
Yeah.
amidst all these economic headwinds.
Yeah, it's definitely a complex picture right now, a real turnaround situation in the making, or at least that's the plan.
Absolutely. And we've got this comprehensive report packed with data, analyst takes, market reactions. It's all in there.
Yep, lots to unpack.
So our mission today, cut through that noise, figure out what's really going on, the strengths, the weaknesses, give you a clear view of LKQ's turnaround attempt.
Let's do it.
Okay, let's peel back the layers. First stop, growth. The report calls LKQ's situation a profound transition, this multi-year strategic thing. What's the core challenge for their growth right now?
Well, the big picture is LKQ is trying this massive internal overhaul. They're simplifying their global business, trying to boost efficiency.
Okay.
But, and this is the key thing, it's not happening in like a stable environment. They're battling some pretty major external headwinds. You've got soft repairable claims volumes in North America, which is a big market for them, and then just general macroeconomic weakness over in Europe.
Right.
And the real headline, honestly, for the forecast period, FY 2025 to 27, is this really severe downward revision to their 2025 guidance. It just came out today, actually.
Wow. Okay. So fresh news impacting this.
Very fresh. And it basically means near-term contraction is now the base case. It makes it a genuine turnaround story, not just, tweaking things.
So negative organic revenue growth projected and a big chop to the EPS targets for 2025.
Exactly.
But here's where it gets kind of interesting, something the report flags.
Right.
While revenue is shrinking, EPS, earnings per share, is projected to grow strongly. How does that work? Seems counterintuitive.
Yeah, it does seem odd at first glance, but that strong EPS growth isn't really signaling, a booming core business.
Right.
It's more reflecting a potential bounce back from what looks like a pretty depressed 2024 earnings base.
Okay. So recovering from a low point?
Precisely. Think of it like shrinking to get stronger, maybe. It's a classic turnaround playbook move sometimes.
Okay.
And this effect is amplified because management's getting really aggressive on costs. They're targeting another $75 million in savings.
On top of previous cuts.
Yeah, on top of $125 million they'd already identified. Plus, they keep buying back their own stock pretty consistently.
Right, the share repurchases.
So the story here isn't organic expansion at all. It's explicitly an efficiency-driven turnaround. The whole investment idea really hangs on whether management can actually pull off this simplification and cost-cutting plan to, stabilize the ship.
Makes sense. So bottom line on growth, the report reads it.
Weak. 2 stars out of 5.
Weak. Okay, so growth is clearly let's say the Achilles heel right now.
For sure.
But a company isn't just about getting bigger, right? It's also about how well it uses its resources. Profitability. The report calls this a core pillar of their strength historically. What's the margin story?
Yeah, this is where it gets fascinating because historically, LKQ has had strong margins, but we're definitely seeing a clear trend of those margins getting squeezed, especially in 2024 and looking into 2025, mainly because sales have softened.
Okay.
Now, their gross profit margin that's actually incredibly strong and stable stays right around 40%.
That's pretty high.
It really is. It speaks to, real advantages in how they source parts and their pricing power. That gets a top rating. Excellent.
Wow.
However, when you look further down the income statement, operating profit margin, net profit margin, you see clear compression since the peak back in 2021.
So costs are eating into that gross profit.
Exactly. The net profit margin actually dipped below 5% recently, which, that's a bit of a concern. Both of those get just average ratings.
And why is that happening?
Well, it's largely down to what they call negative operating leverage. Basically, your fixed costs get spread over fewer sales dollars as revenue falls.
Yeah, makes each sale less profitable.
Yep. And also just more competition, especially over in Europe.
Okay. But there's a positive side, too. You mentioned returns.
Yeah. The returns metrics, return on equity, ROE, return on assets, ROA, return on invested capital, ROIC, they still look pretty strong, mostly rated on good.
So that suggests the underlying business model is still fundamentally sound.
I think so, yeah. It confirms there's quality there, despite the current pressures.
And management, they see this margin pressure, obviously. What are they doing about it?
Oh, they're definitely aware. They're hitting back pretty hard with that new $75 million cost-cutting plan we mentioned.
On top of the $125 million.
Exactly. So the big challenge for them is just stopping that slide in operating margins first, then stabilizing things. That's job one for profitability.
Okay, so overall profitability gets an average rating, strong history, kind of battling these current headwinds.
That sums it up well.
All right, now, financial strength. You need a solid foundation to pull off a turnaround, right? Fund new strategies, weather the storm. What's the report say about LKQ's balance sheet, their cash flow?
This is actually a real positive for them. LKQ generally maintains a solid and pretty carefully managed financial position, and that's critical right now. It gives them the foundation they need.
How so? Like liquidity?
Yeah, liquidity metrics look consistently strong. Their current ratio, for instance, is over 1.5. That suggests they can comfortably meet their short-term bills. That gets a good rating. Quick ratio looks stable, too, decent for a business with lots of inventory.
And debt. Leverage?
Very conservative, very stable profile there. Their debt-to-equity ratio is way below the kind of 2.0 worry threshold. That actually earns a ORYR. Excellent. Impressive. And interest coverage is super strong. Earnings cover their interest payments more than 5 times over. Minimal default risk suggested there. Debt to EBITDA is manageable, though it did tick up slightly to 2.6 times in Q2 25.
Okay, something to keep an eye on maybe.
Yeah, just a point to monitor. Shows debt's creeping up a bit relative to earnings, which isn't surprising given the earnings pressure.
Gotcha. And cash flow. You mentioned that was key.
Yeah, cash flow generation is a definite highlight. Even in this really tough second quarter of 2025, LKQ still churned out a robust $243 million in free cash flow.
Wow, even with sales down.
Even with sales down, and this powerful cash flow is what funds their whole capital allocation plan. It let them give $117 million back to shareholders just in Q2.
Yeah.
$39 million in share buybacks and $78 million in dividends. And they still have authorization to buy back another $1.6 billion worth of shares.
So quite a war chest there. What does all this financial muscle mean for the turnaround then? Does it give them more breathing room?
Absolutely. It gives them the runway, the flexibility they need to actually execute the strategic shift and ride out this downturn without, facing a financial crisis.
Right.
They're not operating from a position of weakness financially, which is huge for a multi-year turnaround plan. It's a stable base.
Okay. Makes sense why financial strength gets a good rating then.
Definitely.
Okay, now things get, well, maybe even more interesting. How is the financial community actually viewing all this? The report highlights a sharp disconnect here, which really grabbed my attention.
Yeah, this is where you see a real split. It's kind of a paradox.
How so? What's the disconnect?
Okay, so on one side, you have the analyst consensus recommendation. It's a strong buy, average rating of 1.43 on that 1 to 5 scale, where 1 is strong buy.
That's pretty bullish.
Very bullish. And look at the average 12-month price target, $52.60.
Whoa. And the stock just plunged to, what, the low $30?
Exactly. So that target implies potential upside of over 70%.
That's huge. What does that tell you?
It suggests a lot of analysts are basically saying, okay, things look rough now, but we're looking past it. They seem to believe the sell-off is way overdone and that the company's transformation strategy will eventually work.
So they're keeping the faith, essentially.
You could say that. Both the strong buy consensus and that high price target get excellent ratings in the report, reflecting that analyst optimism.
Okay, but you said disconnect. What's the other side of this coin? Is it just that the market disagrees, or?
The other side is the cold, hard reality of the numbers right now, specifically the immediate and really severe downward revisions to both revenue and EPS forecasts.
From the company itself and then analysts following.
Yes. After that Q2 earnings shock, management slashed their full-year adjusted EPS guidance by 11.3% at the midpoint. That's a big cut.
Yeah.
And the organic revenue outlook. It went from roughly flat to slightly up 0% to plus 2% growth, all the way down to a decline of negative 1.5% to negative 3.5%.
Ouch.
Big swing. And we've already seen, I think the report said, at least 7 analysts immediately slash their own earnings estimates in response.
So the actions, the forecast revisions, are very negative.
Extremely negative. Those revisions get a poor rating. And, this big Q2 miss, it also breaks a pretty decent streak they had of meeting or beating estimates. So the earnings surprise trend just turned negative too.
Huh. So this creates what the report calls that bullish thesis, bearish numbers paradox. It's like analysts are saying, trust us, it'll be great later, while the current data is screaming danger.
That's exactly it. And the overall analyst sentiment rating ends up right in the middle, neutral.
Why neutral if the recommendations are so strong?
Because that rating tries to capture the stalemate. Analysts seem unwilling to totally ditch their positive long-term view, but they absolutely cannot ignore the harsh reality of the current numbers and guidance cuts. It's a tug of war. Future hopes versus present pain.
Fascinating. Analyst sentiment. Neutral? Okay. So analysts are conflicted, trying to look long-term. What about the rest of the market? Individual investors, news headlines, traders, are they seeing nuance?
Not really. If you look at the broader market and news sentiment, it's pretty much just decidedly negative. Very little nuance there.
Okay.
Take news sentiment. Overwhelmingly negative. Headlines are all about LKQ plunge, misses estimates, slashes guidance, stock drops. You know the drill. That gets a rock-bottom new share, poor rating.
Understandable, given the news.
Then you look at general investor sentiment, think social media, forums, highly negative, lots of fear right after a stock drops 15–20%.
Yeah, panic often sets in.
Right. The conversation is totally dominated by the guidance cut. Any long-term bulls are probably getting drowned out by the short-term noise and worry. That earns a weak rating.
And traders, people actively betting on the stock price.
Well, trader sentiment is pretty clear from that massive pre-market stock plunge, 15–20% drop on huge volume. That's traders voting with their feet or clicks.
Right.
Plus, the report notes that data showed short interest bets against the stock had actually been creeping up recently before the earnings.
Oh, interesting. So some were expecting bad news.
It seems like it. Some traders were positioned for a decline, and the earnings miss basically just proved their bearish view right. So that also gets a weak rating.
So the report's conclusion on broader sentiment sounds pretty unavoidable then.
It really is. That Q2 report and the guidance cut, they've triggered a real crisis of confidence in the broader market. And it's amplified by this uniformly negative news cycle.
Yeah.
Until LKQ can actually deliver some tangible good news, some positive results, maybe stabilize guidance, that broader market feeling is likely going to stay deeply negative. It's a stark contrast to where many analysts are trying to look.
Makes sense. Overall, broader market and news sentiment. Negative. Negative.
Yeah.
All right. So we've been through growth, profitability, financial strength, and the very different views from analysts versus the wider market. Let's try and synthesize this. What's the final verdict on LKQ's core fundamentals? Setting aside the volatile sentiment for a moment, just looking at the business itself.
Okay, yeah. Based on drilling down into those core operational and financial metrics, LKQ Corporation gets a final fundamental rating of average.
Average. Okay. Walk us through why.
Well, it really captures this idea of a company at a critical turning point, a real inflection point.
Yeah.
On the plus side, its profitability metrics, yeah, they're under pressure, but they remain a source of real underlying strength. You've got those best-in-class gross margins, solid returns on capital that points to a durable competitive advantage, a moat.
Right, the stable parts.
And its financial strength is definitely a key pillar of stability. That conservatively managed balance sheet, the strong cash flow that gives them the resources they need to fund the turnaround and keep returning cash to shareholders, even now.
Okay, those are the positives. What pulls it down to average?
It's really overshadowed right now by the weak growth profile, that recent, really drastic cut to the 2025 guidance. It just signals a clear period of contraction, uncertainty.
Right.
It fundamentally shifts the investment story away from, steady, predictable performance towards a high-stakes turnaround bet. And in the report scoring, that weak growth carries a heavyweight 50% weighting.
Okay.
So that heavy weighting on the weak growth score is what really anchors the final rating in that average category, despite the other notable strengths.
Got it.
Yeah.
So final fundamental rating.
Yeah.
Average.
Correct.
So wrapping this all up, what does this mean for you listening? We've seen a company, LKQ, with some definite fundamental strengths, the profitability core, the solid finances, but it's really grappling with these significant near-term growth problems.
Yeah.
And the report makes it crystal clear. Investing in LKQ right now isn't about predictable earnings anymore. It's really a bet on management's ability to execute this big cost-cutting and simplification plan during a pretty tough time.
That's absolutely right. The key question isn't just if their end markets will eventually recover, because cycles turn, but it's when, and maybe more importantly, how well can management actually transform LKQ into a leaner, more focused company while navigating the storm. It's a huge test of execution, of resilience.
Definitely. So as you reflect on this deep dive, here's maybe a final provocative thought to leave you with.
Okay.
Given LKQ's surprisingly strong cash flow, even now, and their clear commitment to returning capital to shareholders, what specific signs, what operational or market indicators would you personally watch for? What would tell you that this efficiency-driven turnaround is actually starting to work, starting to gain traction, and isn't just, treading water?
That's a billion-dollar question, isn't it?
It is indeed. Something to think about. Thanks for diving deep with us today.
My pleasure.
Until next time, keep learning.